Let's look at Exxon Mobil Corporation, which is up 60% year to year. Let's look at Occidental Petroleum Corporation, which is up 124% on the year. Let's look at Chevron Corporation, which is up around 61% on the year. Now understand that all three of these US-based energy companies are well up on the year. I would say that ExxonMobil is trailing. Occidental Petroleum is really up on the year, with Chevron somewhat in the middle of the pack. However, if you look at a lot of the conservative entertainers, the narrative that they're giving about the oil, or really the industry, the energy industry inside the United States, would be this.
Biden is chasing windmills. Joining me now, energy expert and Power the Future Executive Director, Daniel Turner. Welcome back, Daniel.
Thank you for having me, Kennedy. Great to be here.
So if the president isn't going to Saudi Arabia on bended knee, begging the kingdom for dirty gas, he's blaming Putin. So if you're blaming Putin, you don't have to do anything. You certainly don't have to acknowledge your failures on energy policy.
Yeah, he doesn't have to acknowledge that. He has implemented a myriad regulations, punishment of the investors in the fossil fuel industry. Land access has been denied, right? So this is a cause and effect. He put in lots of different causes. He doesn't want to deal with the effect. But going to Saudi Arabia is interesting because it does acknowledge that we need a supply increase, right? He recognizes that the only way to lower prices is to increase the amount of oil in the global market. But why do the Saudis get to drill more for $120 a barrel and not Alaska or New Mexico or America? You'll see he never says anything about increasing American production. He'll say things like, I'm going to lower gas prices, or I'm going to, but he never once talks about increasing oil production in America because the Greens won't allow him to do that.
Joe Biden believes if gas is $5 a gallon or $6 a gallon or $10 a gallon, that if he imposes enough pain, that eventually everyone will have this epiphany and get rid of that truck or get rid of that minivan, and everyone will go buy an electric car.
The angle does not disagree. Now, the Biden team chose to cancel oil leases, to stop Keystone, ramp up all those regulations. They greenlit a proxy war against Russia that threw tens of billions of military aid to Ukraine. Oh, yeah, we can afford that.
We're going to have a higher heating cost in the winter, right? Which there are some places that are projecting that your bill could possibly double during the wintertime, right? Just to keep your house warm. Just to keep your house warm. It's absolutely insane. And this, in my opinion, is what Americans are actually really worried about. This is what they actually really want to get fixed. So what does the Biden administration do, right? What does the Biden administration do in order to try to relieve the concerns of American citizens in regards to this increase in energy costs? Well, I got to be honest with you guys. They're laughing at us. No, I'm so serious. They're actually laughing at us because that's what Miss Jennifer Granholm did when asked about Biden's plans to lower gas prices just the other day. Take a look.
In Sturgis, Michigan, it is $2.89 a gallon. I guess that's better than in California. What is the Granholm plan to increase oil production in America?
Oh my God. That is hilarious. Would that I had the magic wand on this. As you know, of course, oil is a global market. It is controlled by a cartel. That cartel is called OPEC, and they made a decision yesterday that they were not going to increase beyond what they were already planning.
Bro, that's embarrassing. That's embarrassing. If that's not in every Republican ad, they're doing something wrong. That clip has to be in every GOP ad from now into 2024, right? It has to be. She's literally laughing at the idea, guys, of the U.S. increasing domestic oil production and defers and bows down to the Saudi crown prince.
Now I want to ask yourself, based on what we looked at from those energy companies based on their share price, based on their dividend yield. Ask yourself, what is missing from the narrative created by those conservative entertainers? The first narrative, or the first piece of the puzzle that will be missing, is how markets actually function.
What is a market? A market is any place where makers, distributors, or retailers sell and consumers buy. In this context, the word market means marketplace. People buy and sell things in shops, high streets, exchanges, street markets, or websites. The term may also refer to the whole group of buyers for a good or service. For example, the market for sports cars is quiet this year. Businesses that operate in markets are usually in competition with other companies. The other companies or rivals offer similar goods or services. When the press or TV reporters talk about markets plummeting or going through the roof, they are usually referring to the price of shares, commodities, or other derivatives. For example, the headline, "US markets suffer biggest one-day loss in almost 4 years," refers to Wall Street, i.e. US stock markets.
The next piece of the puzzle that will be missing is who really controls the energy or the oil market. Now, when we're looking at the oil market and we're talking about who really controls the energy or the oil market, let's first look at supply and demand. And reason why we look at supply and demand first is because it's fundamental to every market. As long as a outside force does not try to influence or intervene in supply and demand, we pretty much can always understand the direction the market is going and why it's going in that direction. And therefore, to really understand, right, what is going on in the energy or the oil market, you need to understand the fundamentals of supply and demand. You need to understand how supply impacts price, how demand impacts price, how surpluses and shortages also impact price based on demand at that given time and supply at that given time. Then what we want to do now is start looking at world politics and world events and understand how can world politics or world events, or some people call geopolitics, how can they influence market perception, one, and then also influence supply and demand, which then now transfers into influencing market perception. Now, once we understand those two elements of a market, we want to now look at the oil traders. And one of the reasons why we want to look at the traders is because to the average person, this is the element of the market that's hidden from most people. Most people, when they go to a gas station to pay for their gas, or they're paying their heating bill, they're paying their electricity bill, they may not even know that oil is a commodity traded on the world market by oil traders. And therefore, to really understand who's really controlling this, we got to ask the people and talk to the guys that actually trade this commodity.
What we do here on this floor is we essentially coordinate the supply of crude oil to our refineries. We look after marketing the crude oil that we produce as a company. And then we do the most important bit, which is use that information to make some money for the shareholder. I've been trading in Shell for over 20 years. Been very fortunate. The company sent me all over the place to do trading in places like Singapore, Melbourne, Australia, and now back here in London for the past 8 years. I came in from our marketing organisation where I was in our strategy unit as a graduate starting job. Title was business analyst, and I very quickly realised that there were some interesting areas to branch out into, and trading was one of those where I could use my languages, use my international experience, and see the world. The trading room is a great leveller. You've got an open plan office space where everyone is in close proximity to one another, and the density of activity means information flows freely. But it also means that people of various seniorities and various levels of experience have the ability to interact with each other in a critical manner. So if I see a headline and I exclaim that I think it's bullish, somebody can disagree with me and say, no, Mike, actually it's not. And that's just fine. That's quite unique to this business.
I left university, did a management degree in Manchester, and joined 6 years ago. I did an internship at another company actually at the end of during the summer of my second year, and then I joined Shell, or was applied for Shell and was accepted just before the end of my final year of uni. Working at someone like Shell gives you an advantage over some of the more financial institutions because here we have a large physical network and you can get to understand a lot about the way that the actual physical gas flows, so where the molecules flow and how the markets work. It gives you a much better physical understanding of the positions, which you might not get at a different kind of shops. So if you are interested in learning sort of that side of the business, which is extremely important in understanding what happens at the market, then I would say Shell has a big advantage in that over some other shops. I started off working as an analyst, which gave me quite a good fundamental understanding of the way that the gas flows worked and the supply and demand balance. That's very important for understanding what's going to happen in price. And when we're making our trading decisions, we use that information a lot in order to help us to decide when we should be buying and selling.
Now that we have a better understanding of kind of the elements of the oil market, some people also call it the energy market, the question we want to ask ourselves is, why would oil corporations or energy providers, why would they want energy or oil to get less expensive at this current time? They're coming out of the pandemic in which consumption had gone down because people were not as mobile. They weren't moving around as much. The travel industry was really, really contracting. They're now in a particular cycle where they're able to drive a large amount of revenue, a large amount of earnings, drive that value back to their shareholders. Why would they want to increase supply at a point to where the price of oil becomes less expensive, which therefore can decrease or contract the amount of value that they can return to shareholders? Let's also consider things like capital expenditure. What does it cost to drive new production? There's an old story about a gold mine, and somebody says, hey, I got a gold mine that's worth $10 million, right? The value, the estimated value of gold in the ground is $10 million. The downside is it's going to take $30 million to extract it. And therefore, that's what I really want to encourage you, is that when you're looking at these kind of issues, understand what capital expenditure is, understand what capital budgeting is, and understand what is the cycle of extraction. What is the cycle of building out the capacity to extract or the capacity to refine? We're going to go into that a little bit later in another segment, but I want you to understand, if the oil corporations are coming out of a cycle in which they were contracting because of geopolitical situations, because of world events, because of a decrease in demand, which means they no longer they can no longer necessitate or create a business case to supply at a certain level. Now things have changed. Why would they destroy their own demand? And these are the questions you want to start asking yourself so you can really understand how to navigate these markets effectively.
Why are U.S. oil companies not ramping up production to cash in on record high gas prices? It seems like every day we hit a new record at the pump, and you would think oil companies would race to snap up land and drill new wells. But many companies report they're sticking to their previous plans for growth instead of quickly ramping output. That's despite the fact that the price of a barrel of crude oil hasn't fallen below $100 since the beginning of May. So why aren't they drilling more? In a survey done by the Federal Reserve Bank of Dallas, oil executives blamed Wall Street. Close to 60% cited pressure to maintain capital discipline. According to economists, the energy market has been volatile in the past, so investors are looking for companies to pay down their debt and pay off shareholders instead of investing in new wells. It's not all bad news. OPEC Plus agreed to increase supply this summer. The group of oil-producing nations said it would raise by 50% an already planned production increase. But the announcement has done little to move the needle. In fact, oil prices rose after that news came out, which means this could be a pretty expensive summer for drivers. With the Why, I'm Brandy Smith.
The European Union has decided not to accept any oil imports from Russia via ship, which allows Hungary to still receive Russian oil via pipelines. This suggests the market is at peak Russian oil restrictions, if not peak prices, and it's now unlikely that another shoe drops regarding Russian oil flowing into Europe. One might wonder, with crude oil trading well above $100 per barrel, why production is not growing faster. U.S. production costs are much higher for sure, and there are also challenges in how producers manage their risk. The futures oil maturity curve is in backwardation, where the 2-year out price is trading about a 30% discount to the current spot price. Backwardation should not be interpreted that the oil price cannot go higher. It might. Backwardation does mean that the oil flow from a new shale oil well may command a much lower price than today's spot price. This makes getting financing and risk managing the revenue flow more complex and challenging.
Contango and backwardation are terms used to define the structure of the forward curve. When a market is in contango, the forward price of a futures contract is higher than the spot price. Conversely, when a market is in backwardation, the forward price of the futures contract is lower than the spot price. In the chart below, the spot price is lower than the futures price, which has generated an upward sloping forward curve. This market is in contango. The futures contract are trading at a premium to the spot price. Physically delivered futures contracts may be in a contango because of fundamental factors, including the storage costs, the financial cost, also known as the cost to carry, and insurance. The futures price can change over time as market participants change their views of the futures expected spot price, and so the forward curve changes and may move from contango to backwardation. In the chart below, the spot price is higher than the futures price and has generated a downward sloping forward curve, or inverted, which is in backwardation. The futures forward curve may become backwardated in physically delivered contracts because there may be a benefit to owning the physical material, such as keeping a production process running. This is known as the convenience yield, which is an implied return on warehouse inventory. The convenience yield is inversely related to inventory levels. When warehouse stocks are high, the convenience yield is low, and when stocks are low, the yield is high. Over time, as the futures contracts approach maturity, the futures price will converge with the spot price. Otherwise, an arbitrage opportunity would exist.
Energy stocks have gone bananas over the past few months because of some of the issues we discussed earlier in this video. Investors in energy stocks are receiving the massive benefits of being owners of a company that produces a product that is in high demand. Many other energy companies also pay a dividend, so they reward the owners with not only the capital gains, but also a cash payout based on the dividend payout schedule. And what I really want to encourage you to do is when you're looking at these type of issues, dealing with energy, dealing with really any type of commodity, I want to encourage you to look at the overall market. What are the market forces? What are some of the factors that are impacting the market? And not just look at it from a consumer standpoint. Okay? And when you can kind of understand it from an ownership standpoint, from a trader standpoint, from an investor standpoint, you can get a different perspective on what is actually making this market function the way it's functioning. Now, what we're getting ready to do as we close out is we're going to show you an interview from Bloomberg with the CEO of Chevron. And the reason why I want to have you watch this interview is because I believe that you can get a much better perspective of how a CEO of a company whose goal is to make sure he returns value back to his shareholders, what are his plans to continue down that road, but also mitigate the risk associated with the business activity and make sure they maximize profit, but also shareholder value. Go ahead and check that out.
Where are we in this cycle?
Well, we've seen a cycle that, frankly, is different than past cycles. In the depths of the pandemic, demand collapsed at a rate we'd never seen before. And activity contracted because it had to, and there was no demand for incremental production. We were looking for ways to store production that the world really didn't need. And now we've seen the reverse of that and a dramatic increase in demand, economies that have largely reopened, but not completely yet.
So no sign of demand destruction yet, based on where we've been?
No, quite the opposite. We're still seeing real strength in demand. We're seeing, international air travel is the strongest since before the pandemic. China still has a ways to go. So a lot of signs that demand continues to be very strong. And demand typically in our industry moves faster than supply in both directions. And we saw that in 2020. We're seeing that today.
So in terms of supply, you are working hard in the Permian. Your production is looking to be 17% or 15% increase, right? If I said to you today, pump more, literally, could you?
I couldn't pump more today. The incentives today are to pump as much as you can. And the decisions that lead to today's activity were made 2 years ago. And there are lead times in all of these things. It's land work, it's permitting, it's roads, it's infrastructure, it's drilling rigs, completion crews. There's a lot that goes into planning and executing production growth. Last year was the highest year of production in the history of our company. First quarter this year, we were up 10% versus first quarter a year ago. So we're doing our part to meet this growing demand, but it's not instantaneous. It requires a longer lead time. Even in the shorter cycle portion of our activity, it doesn't happen quickly.
So if we pretend that maybe it could, where's the biggest bottlenecks? Is it sand? Is it labor? Is it wages? Is it transportation? Like, where's the problem?
In the U.S., in particular the Permian Basin, where there's the most activity, it's all of the above. During the pandemic, operators, shut activity down. The companies that support our work had to do the same. Workers left and went to other parts of the country. Rigs were stacked up. Those that were still in the field, when they had maintenance issues, you took parts off of rigs that were in the yard. So all of those things now need to be reversed, and so there are very real constraints. I mentioned earlier, we plan our work and then work our plans. So our plans to continue to grow were laid in place even back during the depths of the pandemic. But to incrementally change that right now, there is a lot of work that has to happen and a lot of constraints that have to be solved for.
Like, it wouldn't matter how many times the stock hit a 52-week high, or it wouldn't matter like what the oil price was, is what you're basically saying.
Yeah, the price of the day doesn't influence our capital decisions and our activity. We have a long-term view on supply, demand, markets, technology, policy, and that's what sets our capital spending. We've been very disciplined with our capital spending. We've laid out a plan to our shareholders that says within a pretty narrow range of capital activity, we can grow cash flow, we can improve returns, and our production will also grow. And so we're on that path, and we've stayed on that path. And executing that with discipline is really important for companies like ours. And so to deviate from that because the price today is higher, the price 2 years ago was low, is really not how we run our business. We see our way through cycles. It's always been a cyclical business, and so we continue to take a longer view on how we set activity.
We'll get to the policy part in just a second, but on costs, I know you've sort of looked at costs and how they're going to increase this year. What's your visibility into next year? Do you have an idea of what your cost inflation profile is going to look like?
We're working on that now, Alex. We're pretty well covered this year because, again, the contracts and all the things that go into our activity were really established, quarters back. As we look to next year, we're working with suppliers. We're looking with the people that supply goods, services, inputs to us. And there is the inflationary pressures that the economy sees are certainly present. We have strategic relationships with a lot of the people that we work with. We didn't bring our activity to zero during the depths of the pandemic. We kept work underway. We have a longer term contractual relationship. So we have some ways to manage those costs, but clearly the pressures are up across the entire economy, and our industry is no different.
Double digits? Do you know yet?
It's early to say. We're right in our planning process right now, so it could be high single digits, could be low double digits. It varies around the world. Certainly in places like the Permian, where there's a lot of interest and activity, you can feel more pressure than you would in other parts of the world and other types of activity in our business.
Well, let's stay here in the U.S. for just a second. So obviously, it doesn't matter how much oil you guys can really pump, because the real crisis is in the product market, and that's really a refining issue. There are just not as many refiners running as there were 10 years ago to create the product. So on that point, I spoke to Secretary of Commerce Gina Raimondo yesterday, and I said, have you been talking to executives? What's that conversation like in terms of creating more products? And this is what she had to say.
That we can, including, working with the private sector to increase supply of energy sources.
Have you talked with the administration recently?
I've not spoken to the administration recently. I expect that I will. I'll be in Washington next week, and I hope to meet with people there. I've spoken to the administration over the past several months. But you're right about these bottlenecks in refining. We've seen refineries close. When I began my career, there were more than 250 refineries in the U.S. Today, there's half that number. And we've seen refineries close around the world. We've seen China stop exporting products. Obviously, Russia exports have diminished as well. And so many of the sources of product, that normally flow into markets markets have been constrained, and we're seeing very strong demand, as I mentioned earlier, and that's resulting in a lot of upward pressure on prices.
So if you go and talk to President Biden or the White House next week, what would you want to tell them? Because in essence, no matter what price signals you're getting from the market, the world is moving to phase out the products those refiners would use. That places you in a tough spot.
It puts the industry in a difficult spot because building a refinery is a multi-billion-dollar investment.
Process.
It may take a decade. We haven't had a refinery built in the United States since the 1970s. My personal view is there will never be another refinery built in the United States. But you're looking at committing capital 10 years out that will need decades in which to offer a return to our shareholders in a policy environment where governments around the world are saying we don't want these products to be used in the future. And so there really is a dilemma. We receive mixed signals in these policy discussions, and my message would be we need to sit down and have an honest conversation, a pragmatic and balanced conversation about the relationship between energy and economic prosperity, national security, and environmental protection. We need to recognize that all of those matter, and we can't over-index on just one.
You've been at Chevron for many decades. You were a refining guy. Did you ever think that we'd ever see global refining margins like this and possibly sustainable?
I've not seen margins this strong during my time in our refining business. It's a unique set of circumstances. We're coming out of a once-in-a-century pandemic, very strong economic growth. As I mentioned, some things that have constrained product supply into markets, and it's a set of circumstances that we really haven't seen before. These things never last forever. And markets work. Sometimes it takes time. There's an old adage, the cure for high prices is high prices. And the reason some of these sayings are around is because they're actually true. The price signal suggests producers should produce more, consumers should consume less. And eventually, that dynamic does bring prices back into a lower range.
Do you think we could ever be in a world where we're going to have to ration gasoline? There was reports about potentially that happening on the East Coast. Like, literally, could that actually happen this day and age from where you see it?
Markets are very efficient today, and as long as the infrastructure exists and the ability to supply markets is not constrained by interventions, I think that really diminishes the likelihood that we could have outages. Now, you can have a hurricane, as we saw with Hurricane Rita, Katrina back 15 plus years ago, that can cause localized outages. You can have things like that, but I think if we allow markets to function, markets will get supply to where it's needed. But interventions in markets that are sometimes well-intended can create unintended consequences, and that's where outages, the likelihood could go up.